Good evening, everyone who's joined us today for the book launch of Demystifying Venture Capital by Mr. Mohammad Mustafa. And our host, Latha Venkatesh, will engage with a Q&A with him, asking him the history and the motivation behind his intent to write this book. I'm Karthik Reddy. I'm co-founder at Blume Ventures, managing partner. I also happen to be the Vice-Chairperson of the Executive Committee of the IVCA, a role that the new Executive Committee took on in April this year. We've not met after that, other than virtually. And it's been an interesting year, and also an interesting year for a book of this nature, where more people are sitting in their rooms and thinking about venture capital, entrepreneurship. And what Mr. Mustafa has offered is a primer on exactly that from his experiences. Quick minute story before I hand over to Latha. We were already a recipient of SIDBI's capital as LP in Fund 1. And then we ran into Mr. Mustafa, taken on his new role in the mid-2000s, mid part of the last decade, when we were pitching for Fund 2. And I noticed a sort of curious skepticism. Why SIDBI was deploying a bunch of capital into venture capital, and Mr. Mustafa was a quick learner. So by the time we went and met him the second time, he was asking, very sophisticated, very difficult questions, and he will tell you how that experience and that learning translated itself to this wonderful book. I've browsed through it. I can't say I've read every part of it. I'm a happy contributor as a part of Blume as one of the 10 funds. And I think it's an incredible primer to, and I'm surprised nobody's done this before. It's an incredible primer to the Indian venture capital ecosystem, which cannot be simply cut-pasted from the US context. And therefore, I'm glad somebody like Mr. Mustafa, from the seat that he occupied, dealing with, giving capital to 30, 40 funds, chose to write this book. So thanks a lot, sir. Congratulations again on the book. And Latha, over to you, ma'am.
Thank you very much, Karthik. Feel likewise that this is such a useful book. I too have browsed and maybe read thoroughly about 2 or 3 chapters, but it gives such an in-depth understanding into what the venture capital scene is. Congratulations, Mr. Mustafa. Mr. Mustafa is known to everybody more as someone who has had an illustrious innings at SIDBI, where he must have come across a lot of MSMEs and discovered that some of them are excellent, partners, excellent candidates for venture capitalists and can be scaled up very well. That probably was the inspiration. So first, Mr. Mustafa, welcome. And if you can show the cover of your book itself, Demystifying Venture Capitalism or Venture Capitalists, if you can show that cover. And there it is, Demystifying Venture Capital. Clearly, we know more about venture capital in the US and not so much about India. So if you can start by saying what inspired you to write this, and then we have lots more questions for you. So tell us, why did you write this?
When I moved to SIDBI in year 2017, in August, I hardly knew anything about this subject. I had read something in economic newspapers, but I did not know the subject. When I went there, it was a very different world. On the one side was banking, which I was dealing with, which is highly regulated. On the other side, we have venture capital, which there was hardly any regulation, maybe except the IF registration part. So that is what motivated me. And how is it happening actually? How can a person put his money knowing that 6 out of 10 investments are going to fail? So it was very different form of financing, which was there. So I thought it's very interesting. So that's how I decided to learn it, talk to people like Karthik and even others, and even those who were working with me. And then I took notes on various subjects, how it works, how a firm is formed, how LP, who is LP, what does LP do, how performance is measured, everything. And then I ultimately, when I completed my note, I realized that it's a good small handbook. So later on, I expanded on that book. And then that's how this book was written, because then I realized that this can be very useful, because this is written by a person who has hardly any background in venture capital before starting my innings in SIDBI. So it's very, very pure, except maybe the performance chapter where you'll find some jargon because there was no way to avoid. Otherwise, I have tried to avoid all the financial jargon as much as possible. So this is how the book was written. It's different from other books in the sense that you will find very fewer books in India on Indian venture capital as such. So after while I took notes, it was a handy reference. What the second part that I did, I asked 10 of India's top funds, actually 30 of India's large funds, to contribute a chapter. And how do they work? What is their investment strategy? How do they move money? How do they make losses? How do they constitute team? How do they select a deal? What is due diligence? Where do they falter? Why do startups fail? So these were the questions that we asked them, and all of them agreed very graciously agreed to write a chapter. So I got those chapters, whipped through them, and then based on that, revised my notes further, and then supplemented with the research. And that's what we are seeing now is actually a result of all that. It's about almost a year.
All right. Okay. Okay. So, you have to whet the appetite of your audience to buy the book and read it. I'm excited because I think it's a superb compendium. It teaches so much in so little time and so crisply. But if you can tell us, what were the outstanding success stories, or what is the success formula for a venture capitalist? Don't reveal everything, but some ideas, for a successful venture capital.
The right person to answer this will be Karthik Reddy. How do they make money? But see, the fact of the matter is that the venture capital is all about making money only, right? So basically, it's all about making money only, and then they are not looking at.
You have to wait for a long time, isn't it? According to your table.
30% IRR is very simple. It's very normal and very common in venture capital. So if you look at the returns, there's a phenomenal, some of them better not, in fact, discussed also because they are mind-boggling. But the fact of the matter is that they have to balance their risk. When they make 10 investments, they know that if you go by the success ratio, I think the US literature will say that 8 will fail and 2 will outperform, and they will make good for everything. In India, I think the situation appears to be slightly better. If I can, my research says it can be 3 to 7. Some of the funds have said no, it's more better than that. But actually, it cannot be. That is too good to be true. So and where do they do? Obviously, they have to look at the business, and that is one important. And the scalability is very, very important part. And the third thing that they have to look is the team, because this team, this founder, this is very important because they are investing in something which has not yet been proven, or maybe which it still needs to be tested. And here, you see, this founder part, the subjective part of this venture capital is the most exciting and the most problematic part of it. Exciting in the sense that you are taking a risk based on certain, some of it is actually intuition. I've been saying this again and again. And at the same time, there is a problem also because of that. What happened in that company, which there is one US company which was in this real estate.
WeWorks.
Yeah, WeWorks. See what happened because this all founder because where the founder was given more value than the governance in the company. So you know what happened there. So the formula for making money, I think it's a tightly kept secret by venture capital.
I will come to the red flags. I'll come to the red flags and the failures in a minute. But let me get Karthik in. Karthik, is there something like a success formula, some do's and don'ts that you look at?
I think you weigh probabilities, Latha. So I think venture is a game of probabilities, and which is why the formulas of failures versus successes have held very somewhat rigidly over 6 decades now, right? So a lot of our LPs, by the way, actually tell us sometimes you're either diversifying too much or you're not taking as much risk. That's what we pay you for. If we wanted less, then we would go and put this money into private equity or public markets. And I've noticed a question on the question board which says, can you envisage a world without venture capital? I think we're past that point. Like many things in history, you reach an inflection point where you can't envisage a world without risk takers like ourselves, because that industry, that innovation is what propels the world forward. And the complexity of the problems that, yes, mostly man-made, are further propagated in terms of the problems that get propagated at speed can only be solved with new solutions, right? Legacy solutions don't work. And that knowledge of, or dependence on technology is what drove venture capital, and it will continue to do so, I think, for at least our lifetimes. And so that's when you're judging the opportunity set, so to speak, it's exactly what, it's not like you have a magical formula which is different from what the world's best venture capitalists do, which is basically the market opportunity and the size of the market, because everybody's playing for incredibly large outcomes, and a team which is actually capable of scaling to that outcome. So I think the big challenge is you find first-time founders, or even sometimes second-time founders, who are actually being asked to build a team and an organization which is at a scale of 100 times what they've ever built before, right? And that is non-trivial, because you're essentially saying, much like the number of customers you can win, you as a CEO, you as a founder has to grow with the business. And that's where actually most of the faltering happens, if you ask me. So if you're trying to, there's no foolproofing of formula, is putting a formula.
Of course.
But you're then judging now when the person walks in after the wisdom of 5-7 years and a lot of failures, you're basically judging whether the entrepreneur is able to envision this market size opportunity and can actually build, can attract. They have to even sell their junior employee, number 20, to actually join them on the mission, right? So it's all about just selling a mission. It's not about hiring. It's about literally selling a mission, right? And that's why Elon Musk is who he is, and Steve Jobs is who he was, etc. And there's some of the best success stories which have been venture backed. And so I think that is no different in the Indian context as well. Venture backed founders are personalities in themselves. They're forces of nature, and those are the folks who create the most impact and the most scale.
Yeah.
Okay. Well, okay. You can't have a success formula. I take that. But Mr. Mustafa, since you saw through all those 12 top venture capitalists who have written for the book, I mean, that's a very wealthy part of the book. But you have extracted from that and given us something in the nature of red flags. Can you tell us something about, tell your audience something about that? What did you learn in terms of what venture capitalists should look for as red flags?
Actually, see, if you look at the classical textbook, classical playbook of venture capital, so they will look for basically a good idea, a good business model, scalability, a good team, or a good founder. That's how they make money. But the problem is that if you don't make a perfect balance of all these factors, that this much of it is for a good business idea, this much for a good team, a good founder. So that's what happens. And if you look at why do they venture capitals, they falter basically because they fail to judge the startups. And why do startups fail? Because they can fail for multiple reasons. It is a market fit, maybe conflict. Sometimes even this conflict management is also a serious issue between VC funds and founders. That's very, very important. And this, what I have realized, this operational and behavioral aspects of deal making are very, very important thing. And any company, if you go through the second part of the chapter, second part of this book, you will realize that the bigger the fund size, the detail is due diligence. But how is it happening? So more where the process is more clearly defined, though it is known to everybody now. The text also, the examples also, the playbooks also, but still everybody doesn't do like this. Like there are some people still use their gut, some people still use their intuition. And then obviously this trust thing and right thing. See, that is very, very important. So I believe this behavioral.
So you point out some red flags, like, when key personnel leave, or when, losses mount as red flags.
Yeah. See, so that's all part of basically, because they have to see when the business actually becomes unviable, how long they can remain in it. So that they have to see where they see clear conflict of interest, where the founder is going the other way and the company wants to go where the founders are also conflicting. So these are all different kind of red flags which the companies have to, which the venture capital companies have to see as to how to look at them. So this is basically, you can say it's derived from their experience, but actually, ultimately, even after this, if you look at, because we don't have the best practices as such in India. If you look at many countries, US, Britain for that matter, even Europe, even some Russian countries, they have got best services, best practices codes, which we still don't have. Right now, we are beginning in that direction. I think as CFD is becoming more and more diligent, I think we will move in that direction quickly.
Okay. Well, Karthik, if I can get you in on this, Mr. Mustafa has a very nice chapter on relation between the LP and the GP. I didn't know these abbreviations. I know that now, limited partner and general partner. Okay, the one who is executing the commands of the limited partner. Can you tell us whether they fall out very often? And if you have read Mr. Mustafa's chapter on that, to what extent can you keep the LP informed? And how much should you take them on board? Are these the trickiest questions in running a venture capital fund?
No, it's one side of the problem. So I think the business is two-sided, right? The so-called VC firm is actually sitting in the middle of a marketplace and is an adjudicator of capital, which the LPs finds too difficult to judge. LPs are large pools of capital which don't want to micromanage the capital. So they find managers like us, 30, 40, 50 of them, and allocate. Now, and the other, so forget about the entrepreneur side has its own challenges, but eventually this is a raw material. In this business, there's only one raw material, which is money, right? Apart from the team that you build. And the raw material is, you have to keep the raw material providers happy, otherwise they can choke you out. It's not like there are easy parallel pools of capital. As Mr. Mustafa said, eventually every one of us gets judged by what is your IRR, right? And they will give you some leeway for a trend line for the first 8-10 years of your life as a fund house. But you can't stretch your luck beyond that 10th year. So in the interim, therefore, because you don't have a miracle wand to tell them exactly what returns you'll generate at the 8th or 10th year, it's very important to keep them informed. So it's much like how you would do board management or shareholder management in a company, Latha. So the caliber of that, when you become a second fund or third fund or you have institutional capital, is no different from being a startup at a Series C or Series D stage, which basically has to manage its board members very, very efficiently. I'll actually say that this is one step further complicated, because unlike a company where your earlier investors are not expected to lead the next round, it actually hurts you if your existing investors don't lead and bank your next fund, right? Okay. And in fact, you want to get their commitments before you go to the market, because the market is going to say, how much are your existing guys putting? And if they, God forbid, you don't have the right answer, then you're in trouble. So which means that you have to, it's not about humoring them, but basically being very transparent, being very collaborative, especially with the anchor investors or the top 5-7 investors. You can't do it with all 70 or 60 or 50 that you have. But the key investors drive your fate in this business. And you should be careful about who you take on. And then you should actually have a relationship, much like what the term suggests. The abbreviation is borrowed from the American system. We are partners. There's no getting away from it. In fact, I say that when an LP actually commits to Blume or any other fund, basically what they're actually making is a 20-year decision. They're making a decision to invest in 3 funds in their head, not one fund. So they give you money at T0, T3, T4, and then T7. And the last money you'll return to them is a T19.
Okay.
So they want to make a judgment on, is this guy or girl or this team good enough for me to fundamentally back for a 15-20 year period, which is a huge question. So it has to be immense faith and trust in winning over LPs, in my opinion.
Okay. Mr. Mustafa, you want to add to that?
Yeah. This relationship between GP and LP is actually the crux of the whole thing, because ultimately where the money is coming from LP, and LP, where is LP getting money? Maybe he's getting money, maybe he's investing his own money, but maybe he's getting from somewhere else. Maybe he's parking somebody else's money with the GP. So ultimately it is trust. And obviously part of it, make 75%, I will say it's based on the historical past records, how a GP has worked, how GP has performed with that LP. And obviously 22 is still trust is a very, very important factor. In any part of this business, trust is very, very important. And they are actually, LPs are completely dependent on GP because they are the ones who are making the money for them. And ultimately, everything, when they are answerable to somebody, it's all with them. And that's how, if you see further now, so much of this relationship is actually developed in some cases. It's not happening so much in India, but in other countries, that later on LPs make co-investments also.
Yes.
Yes.
Okay. Actually,
Later,
I
along with
wanted the audience to know that there is a superb chapter there on this relation between GP and LP. And
GP, yeah.
I'm sure much of that will be exemplified in the second part of the book, where people like Karthik Reddy have actually written their own experiences. Mr. Mustafa, the other point I wanted to, which intrigued me was you've given us a very rich set of charts on everything in terms of the amount of money invested, number of ventures, and exits. All these charts, one thing is common. The activity was very high between 2015 and 18. And 2019, we see the bar charts all coming down. Is there some, poor experience after 2018? Why are the charts flattening out after 2018-19?
See, if you look at, I will just give you a BC growth phase in India, then you will see what actually happened is between 11 and 15, the industry was actually experiencing very rapid growth. So multiple VCs entered, became active participants in the Indian economy, or a lot of LP money was also coming. This was also the time when institutional investors like SIDBI were also getting active. But then after this euphoric phase, there was a moderation with 2015 and 17. And this was happening basically because investors were not very sure about the exits. You see, exits is a very, very important part of this business. And in India, still a thing which we haven't seen many exits, particularly in terms of IPO. So we have seen in terms of secondary sale. But I think after 18, you can see again that buoyancy has come back. And secondly, we'll see what is happening. The traditional LP is actually moving away from India. So those American houses, there is a decline in the overall commitment that they have been making. And why? Because they are the adjusted dollar return, because they're not getting the same amount of money which they would have earned otherwise. So that is what is making. But now it is being replaced by whether the money is coming from Middle East, the money is coming from, say, domestic, like SIDBI has come into effect. Or even, see, if you look at one of the things that we've talked about in the book is that we have to have more LPs. And how it happens, we can have only public money, the pension funds, insurance funds. So they are allowed, but only minuscule part of it. They are not allowed to go beyond it because this is somebody else's money and this is the pension money. So now there is one issue that we've discussed is benchmarking of the performance. Ultimately we have to know that how much return one will get based on historical. Maybe I make 10 investments, maybe 4 will go bad, maybe 6 will go bad, but ultimately some money, some benchmark. US, it is much better. Even in India, if you come, if you see these funds, leave aside Karthik, but there are certain funds in India also, what they will show a different kind of rules, because if they go for a different LP, they'll go to IFC, they will show a different story. If they go to, say, a private fund, they will show a different, and to SIDBI, they will not show anything actually. See, so it happens actually. So I think this benchmarking of performance is very, very important. And this, I think this SEBI is looking at it, and I think they will plug it. Yeah.
Okay, well, actually, we're getting questions from the audience. So, viewers, there's one Ajinkya Jadhav who has asked, wanted your perspective on what are the key decisions that go into when an VC invests its dollars in companies which are only making losses. So, what exactly would you look for when you know that there are only losses initially staring at you? Anything you found out, Mr. Mustafa?
Dream, and then secondly, see, ultimately, if you see, dream, and the secondly, if you look at this is actually, this business goes by power law. See, power law distribution. It's not that simply you invest something, you earn something. Some people will actually be making losses in the beginning, but later on, they will give you a good return. So, right. See, if you look at the big
Karthik, you want to come in on that?
Sorry.
Go ahead, Mr. Mustafa.
Yeah.
Go ahead, sir. Go ahead.
Yeah. So that's what I'm saying. So it's a different industry. And if you look at some in the book also, some of our funds have talked about it, that they allocate capital for different companies for different phases on a different benchmark. So somebody needs to burn money early, somebody will need to burn money later. But ultimately, as I told you, ultimately the hope that there is a business which is scalable and which is ultimately going to earn money. Because why people see if this is the why SoftBank is wasting money on WeWork? Why Uber, if you see Uber is still, I think global is still a loss-making company. It is still not profitable.
Okay.
So that, but ultimately they hope ultimately what happened in case of Amazon will also happen in case of these companies. So that's the hope.
In case of Uber.
That's why people are investing.
Okay, Karthik, you want to come in on this? Why would you be burning money in a loss-making company?
No, not very different. I think the two trends which have propagated this, to be honest. One is, the American and the Chinese economies, given the scale and the purchasing power, can actually support a deeper pool of losses before they actually turn profitable, right? And because eventually, if you're able to shift behavior in a market of that nature, the spending shift to something which is brand new in terms of digital or in the way healthcare is given or the way education is conducted, those dollars when they shift are very, very significant. So people are willing to acquire those customers at ridiculously larger costs upfront because the long-term value of those customers can easily outpace that. I think the risk is in foolishly trying to mimic that in economies which are not able to sustain that long-term value. So sometimes in India, it feels like you're burning capital for a little longer than you should be because you're trying to mimic what's happening in China and the US. So I agree that we could have built more frugally in certain companies, certain industries. But the fundamental trait, though, and of course, people have seen success stories before. So, like you rightly said, whether it's Amazon or whether it is eventually Facebook, Twitter, they all found their business models. But when you're fundamentally changing behavior, you are breaking some conventional infrastructure and behavior and shifting it to a new behavior. And that takes a long time. Like people ask, how come Flipkart spends so much money? That's because they built an entire logistics supply chain all on their own. None existed. In the case of Amazon, they just had to click a button and USPS stepped up and became their logistics arm. Like the USPS actually delivered 100 of the 140 million ballots, I think, were delivered by USPS.
Ooh.
So just to give you you'll say, oh, you're the public sector delivery head, but they're very sophisticated. Amazon was built because of USPS. Netflix was built because of USPS, right? Netflix used to be a DVD rental company. Which actually, so see, when you don't have that infrastructure equipped to scale a new business model, you are building that infrastructure. Payments is being built for you. So it takes a lot more courage to build deep. And if you think about it, Latha, full credit to the foreign investors who had those guts. It's not like me, you, and the public markets of this country are funding this, right? It is the Tigers and the SoftBanks who have the courage to fund this.
Yeah, they can do.
Because they've seen it elsewhere and they're willing to. We are the happy beneficiaries of discounts, so we should be happy. And they're also training tens of thousands of engineers and ops and product people, which are happily coming and becoming new startup founders in my 2020 startups. So I'm immensely grateful. So I don't think we should overthink it as much as long as, Schumpeterianism is at play, creative value, destruction is replaced by creation of some kind, right? And that's okay.
Okay. Mr. Mustafa, has the government done everything? I mean, they've tackled the angel tax. That big income tax worry is not there. Is there? I mean, you do tackle government in your book. Is there anything more the government can do, or this is not really government's terrain?
I think
it's the terrain of
universities.
Should
only facilitate wherever they can. There are some tax issues still pending. They should look at it. Then I think the government should do something on the seed stage funding. That's not happening. All the government funds are actually supporting venture funding, which is a letter funding. So seed funding, I think government has been working on a concept which they have not done. And I think they also have to have a program to support academic institutions. They are supporting the institutions which are supporting, but government has not supported them in a structured way. But I think something now, what you call supporting innovation, now Niti Aayog has also started. So I think government has done something, but government has to enable those pension funds. SIDBI has to come forward. They have to allow more. And I think ultimately these pension funds have to, they should be allowed beyond I think that limit of 2%. So they should be allowed to invest more. So that will actually open up huge money. What is going to see, this mutual fund story is driven by what? So this money is actually very important that this comes. Ultimately, we have to be very, very clear that the LP's profile of India is changing very fast. Unless we have domestic money and domestic people have money, institutions have money, but they should be encouraged. There should be incentive for them to come forward.
All right. Okay. You know, they're getting a wide variety of questions, not necessarily that you have answered in the book. I think, Karthik, a lot of people are asking you questions. There's one Pankaj Soni who is in the ed tech startup space. And he says when he went to ask people money, VC firms told him, your business is already profitable, you don't need us. He says, I can't even understand what that means. Do VCs only like loss-making companies?
No.
No, so not 100% true, Pankaj. So I think what VCs are funding is growth, right? They're not funding profits or losses.
Yeah.
You basically give up a significant pound of flesh for the capital that you raise, and therefore the acceleration in value creation has got to justify why you're giving up that much equity. So if you're profitable and you have cash flows, you can get other sources of capital. Growth private equity finds those kind of stable business models far more interesting. There are not as many mid-market private equity players. You're absolutely right. But it doesn't matter at 10 crore or 20 crore or 30 crore revenue levels, whether you're profitable or loss-making. Everybody's a venture person who touches you because they're dreaming along with you that will be 1,000 crore company. They don't care about 30 crores getting to 100 crores and staying profitable. That's not our business model.
Okay.
Right? And so I think that is the perception gap. People will say, how does this become massive and scaled? So I think VCs in a nutshell are greedy for scale and speed, both, right? Okay. Everything else is immaterial in the
yeah, correct. As I said, see, they are looking for, he's put it rightly that they are funding growth. Actually, they are looking at scalability because they want money. See, if the business is not scalable, there is no money. So this, I think maybe some fund might have given him some reason. Maybe they did not want to invest. Maybe they have given him something so that we are profitable. It's not, I think, the right reason. Yeah.
Okay. Well, so actually, we are coming to the end of the show, the last set of questions, and that is on exit. You also say that, exit opportunities for a VC could be a problem in India. Not all of them have been able to exit very well. And there is one Sridhar Raj who's asking that question. Without a thriving secondary market, providing for an exit is tough. And that can therefore even prevent VCs from coming in. Can something be done by NSE or someone on the issue?
I think this is a problem that we've already pointed out. I think he's saying something which is true. Obviously, there has to be there. IPO in case exit is the issue with Indian VCs, and but I think they are doing good. See, if you look at the way things have moved over the years, if you look at some of my chart, how it actually moved in the earlier years. And recently, I've done we were doing a time series analysis for Global Journal Review of Finance and Banking. So there we realize what actually matters. Obviously, there are two factors that we looked at. One is obviously a robust economic outlook. Obviously, India is having that outlook. And the second, one factor that is actually affecting venture capital investments across the globe is liquidity. Global liquidity, US balance sheet, everything is actually affecting this space. It's very interesting space actually. Okay. And I think somebody asked what actually happened, what happens, how do they take decision? Though I think some people will say it's not that they will not like to make it public, but actually this is part of my, I'm doing a PhD actually. And that PhD is on the same subject. Okay. That is, can we make a predictable model for venture capital decision making? So some people will agree, some people will not agree.
Okay.
But actually that is based on, and we are doing that analysis. Maybe later, maybe some of these questions can be answered.
All right. Well, there's one question that's come up. Is it always profitable to, I'll tell you what exactly his question is. Is it profitable to invest in a VC, or do index funds give you similar returns? I want to tell the person that page 11 of the book has a very good table on venture capitals and how much they return in 5 years, 10 years, 15 years, 20 years, and 25 years. Mr. Mustafa has compared it to private equity, to the NASDAQ Composite Index, and to the Credit Bond Index. And according to that table, 10-year is good. They make 14% returns, whereas you don't always make that kind of return. But in 15 years, in 20 years, you make the best return in a VC. Is that right, Karthik? If you compare 10 years and 5 years, then NASDAQ Composite will give you better returns. But if you stay 20 years, then VC is the best return. Is that right?
As an asset class, that is true. The challenge is always finding yourself as a LP in the best VC funds. So there is a honest truth to this industry that almost 80-90% of the gains, the absolute gains and the IRR gains, are concentrated in the top 25-30% of VC funds, right? So if you are, God forbid, in the bottom second half of the funds, you'll actually make terrible returns. You can even lose money if you're in the bottom quartile. So, unlike most other assets, which are somewhat uniform in terms of, or the range is far more tighter, here the standard deviations are far further apart. Much like the companies we invest in, right? And so this is why there is a premium for the world's best funds, right? And they raise money at a drop of a hat. If you're a new manager, then it's a long journey to be able to establish that track record, because it takes 10 years to show results. And that's the nature of the beast. And so I know I can see a lot of aspiring VCs in India, which is fantastic, but the reality is it'll take till 2025, 2030 to actually have all the answers out here. So I don't think you're going to run away.
Actually, you've answered some of the questions. Karthik, you're answering some of the questions, because people are asking, how do you mature into a VC? So you're answering many of that. It's a hard path. Mr. Mustafa, many congratulations for this book. And I found it extremely useful, teaching me so many things, even in that rapid read I had of the book. And I haven't yet read what you are saying is the richer part, the second part where VCs have written their own experiences.
But I think
last 3 minutes, if you can tell us why people should be good.
I will tell you a different story. See, this is one part of it. If you look at the private equity space, this is interesting. So, but there's much more interesting, a much more dynamic space is angel investing. So that is one where I've been working. I've conducted 35 interviews with the top VC angel investors of India. And we have compiled into, I have an agreement with Palgrave Macmillan USA. So that book will be coming out somewhere next year. So that book is actually written how, if you have surplus money, say 5 lakhs, how can you be an angel investor? So that, I think, so that is more important. Becoming VC is far more structured, far more difficult, because some of them are asking what is more important, becoming VC or investing in stocks. So I think our index fund. So they should, I think more seriously about becoming an angel rather than becoming a venture capital, which is far more structured and a late stage in that process. But as far as this book is concerned, I hope everybody finds it useful. Later on, this book, I intend to break apart. The first part will break into a different textbook,
Okay. All right. Mr. Mustafa, it was a pleasure speaking with you. Karthik Reddy, as much learning from you about venture capitalists. It's an extremely exciting book, and it's a great tutorial from what I read of the book, and I haven't read it comprehensively, but it was extremely useful for students, for financial experts, investors, companies, just about everyone in the field.
And for policymakers.
Many congratulations, Mr. Mustafa, and all the very best for the book.
policymakers. Thank you.
Thanks, Latha, for being a great
Thanks,
Thank you,
thanks.
sir.
And Mr. Mustafa, anytime some young VC aspirant comes and asks on how to learn more about the business, if they haven't read this book, then they don't get a meeting. Because it's a basic primer that you have to create. You can't pick up bits and pieces and not have all the pieces of the
Yes,
puzzle. So I think that's it's a great attempt by you to do justice to that, and in that sense, open the door for a lot of people who are asking the same question: how do we become a VC? There's a lot of learning from here, and then you pick up the threads and go meet people and build on this. Thank you very much.
Thank you.
Congratulations.
Thanks.
And good luck with the book.
Thank you.
That's a great last line. Great last line, Karthik. Absolutely tells you why you should read the book. Thank you very much, Mr. Mustafa and Karthik.